1913. The United States did not create the Federal Reserve because it wanted central banking. It created it because the old system had already shown it could not survive panic without a backstop. The country had money, banks, reserves, and clearinghouses. What it did not have was a reliable way to move liquidity where pressure hit first. Cash existed. It froze in the wrong places when confidence broke. 1907 had already proved the point. The system did not save itself. J.P. Morgan and other private bankers decided who would be carried, who would be refused time, and which institutions had to survive by morning. That was enough to stop collapse. It was not enough to be a system. And the weakness was older than one panic. American banking still depended on reserves, locked inside separate institutions, on seasonal swings in cash demand, and on a structure that could expand in calm periods and seize when money was suddenly wanted back. The problem was not how much money existed, it was whether it could move before fear did. That left the country depending on improvisation. Clearinghouses could coordinate, private bankers could raise money, but none of that was permanent. It worked only if the right men were willing, connected, and strong enough to act. Survival still depended on private judgment at the edge of panic. So, 1913 built what the old system had resisted. The Federal Reserve was created to issue currency more flexibly, move reserves where pressure hit, and lend before a shortage of cash turned into a wider panic. It was a backstop meant to exist before the next run began. Even then, the country did not fully trust one center of control, so the Fed was built as a system of regional reserve banks under central authority. The country wanted a backstop, but still wanted limits on who held it. The Federal Reserve was not born from theory, it was born from concession. Once the backstop becomes permanent, control stops being private and becomes policy.